I'm going to be doing a holistic portfolio overview of quite literally every investment that is in our portfolio. If you liked the previous video, please give it a thumbs up, including this one, and subscribe for more. But without any other further ado, let's get straight into the video. So, as you guys know, we like to invest in a lot of dividend securities on this channel, ranging from closed-end funds to, options income funds. And this is just a simple list of, a few of them in the first section of the first portfolio. But here we have the JP Morgan NASDAQ Equity Premium Income ETF. This yields about 9.5%, and it is an options income fund. They invest in, U.S. securities, and they also do options on the S&P 500, I believe. We have River North Opportunities, which is a closed-end fund yielding about 12.8%. JEPI, which is another JP Morgan fund that also does options and holds equity securities. We have BIL, which is a basically bonds, exposure. I like to have bonds in the portfolio. Just helps, to keep cash around and stuff. But it's pretty important because you want to have that kind of exposure in your dividend portfolio. Then we've got these two. Oh my God, these are my favorite as well. QDTE and XDTE, these are weekly dividend income funds, and they yield, those yields over there are not quite accurate, but I believe they yield around 25% a year. Now, sorry, I had to drink some water. The reason these are really good is, again, because they pay weekly, so you don't have to wait the whole month to get your dividend, but I should include that pretty much all of these are monthly dividend income funds, except for those two. I like to have a little bit of exposure to those two because, you get something coming into the portfolio every single week. And it's a pretty new security that just came out from this company called Roundhill. And they're also covered call ETFs, covered put, whatever, options. And it's pretty nice in the portfolio to have. Then we've got, what a lot of you guys come to this channel for, which is sadly not CLM anymore, although I will be looking for an entry point in CLM again at some point. But we have the YieldMax income funds and the Defiance income funds. Now, these are great for income, honestly, because they're monthly and they do option strategies on a lot of stocks that we like to buy. So if we go ahead and start with Amazon and Microsoft, we can see AMDY and MSFO. These two yield between 31% and 50% on the other one, which is really nice in their monthly distributions. Now with these, it's very important on where you get your entry, because if you buy it at the top where Microsoft and Amazon stocks are at the top, it's not the best time to, get an entry into these funds. However, if you're buying them at a certain point of, let's say Microsoft is tanked, then AMZY and MSFO, if Amazon tanks as well, they'll both tank down. And that's a good time to get an entry into these, get a little bit of a higher yield, and also get a little bit of capital appreciation. As you can see, I didn't time it the absolute best, but the numbers that are in the middle between the price and the cost basis, essentially, for example, if we look at JEPQ at the top, the green number plus 1,949, that would be the gain and loss in all of these securities. So, essentially use that for reference as you're looking at this chart. But, when we're looking at these, we're not really looking at the gain and loss as much as we are looking at the yields that we get and then coming to a cumulative picture of how much returns we're making over the period of time. However, outside of that, I'd like to get into FEPI. I like to call it FEPI, but it's essentially a FANG Innovation Equity Premium Income Fund. What that means is it holds all of the FANG stocks, such as, Facebook, Amazon, NVIDIA, Google, etc. These stocks, and it does options on them as well. Now, this one yields about 23%. I think it's important to keep, some sort of kind of range between the yields, because things that yield a little bit lower tend to, pay or are more stable, and they tend to pay less, but they're more stable in price action. Whereas the ones that pay more are a little bit more, like to jump around between prices. You can see 10% drawdowns in a crazy environment, which we haven't seen yet, but it's definitely possible. And then, of course, we have the rest, which are like NVDY, which a lot of you love to invest in, NFLY, which is the Netflix one, MSTY, which is the MicroStrategy one, AMDY, which is the AMD options income strategy, which we've also covered on this channel as well. And then we've got the Block, which is Square. For those of you that don't know, I have an interesting thing coming up, actually, that I would like you guys to look at. And then we've got QQQY, which is the Defiance NASDAQ 100 Enhanced Options Income Fund. This one is pretty nice. Whenever I see QQQ go down, or I see a drawdown day, I tend to put a little bit of money into this one, just because this tends to go down and up with it as well. However, let's get into the second portion of the portfolio, which would be some of the similar ones, except in this one, I have a little bit of a different strategy. I've still got the TSLY, which I covered on this channel as well, but I don't carry that in the first portfolio, I carry that in the second one. The reason for that is because I have reduced my exposure to TSLY due to the amount of drawdown that has happened when I did invest in it. I had to take a loss on it because of all those funds, Tesla is the most volatile. So it essentially draws down and goes up a lot, which makes this fund quite volatile, and it hasn't recovered to the point that I would like it. I would still say right now is a good, entry point for TSLY, but if you had bought in before, then you'll be very much in the red. However, you can see I still have XDTE and a different one, which is actually IWMY, which is the Russell 2000 Enhanced Options Income Fund. Now, this one is nice because you want exposure to small caps as well. Sometimes small caps can do better than the traditional indexes. And if we want a fund that basically covers that and can do options income against that one, then it gives us a little bit more of diversification in our income portfolio. However, you guys can see we also have the one fund that I cover on this channel, which is YMAX, and the YMAG. Now, this is the FANG Mag 7 Options Income Fund, yielding about 38%, and it's another one of those YieldMax funds that I have money in. And a lot of you are probably curious about CRSH, and that's a short Tesla option strategy ETF. The reason I have that is, in the case that Tesla does crash, it gives me some exposure to the downside, where this fund would have some capital appreciation, and it also allows me to make more income off of Tesla's, down days, essentially. But other than that, we have pretty much some of the same ones in this second portfolio. Now, I have to say this, as I do in all videos: principal loss is possible. Shareholders of the funds are not entitled to any dividends paid out by any of the securities in YieldMax funds. And obviously, I'm not a financial advisor, so do your own research. But this is a disclaimer that they have for all of their funds. So, be sure to have some diversification, and also be sure to not invest all of your money in one of these funds. Try to spread it out, because we're trying to build a very diversified income portfolio. So it's very important that you branch out into different areas and are able to, have exposure to different areas and sectors of the market. However, this is something I'm not going to get completely into. These are the non-dividend holdings of this portfolio, but there are two that I really want to cover. But I will just go over the list a little bit. We have HIMS, NVIDIA, Toast, Microsoft, Meta, Mara, which is a Bitcoin miner, Amazon, Elf Beauty, which is a beauty company, SMCI, Lovesac, Liquid Metal Technologies, which is a penny stock that I put a very tiny bit of money into, just in case on the offside that it jumps up like crazy. Square, RH, which is Restoration Hardware. They're a big, pretty expensive retailer for a lot of furniture and like household stuff, like dressers, remodeling, all this kind of stuff. Then we've got Enphase Energy, Beyond Meat, which is the company that makes the meat that is vegetarian or plant-based, essentially. Palantir Technologies, InMode, PayPal, we all know PayPal, Crown Electrokinetics, which is another penny stock that I've been interested in, that I'm waiting for it to go up. Again, I only put in about $500 in this, so it's just a little bit of a play, which I'm also covering all of these plays, these tiny ones, and also going more in depth into the portfolio and doing analysis of every single one of these stocks inside of our private community, which you can find in the description below. If you'd like to join, I'll leave a code below so you guys can use it and get the first 3 months for free, just to see what you guys like, get daily updates in the chat, and so on and so forth. But outside of that, we have, like I said, InMode, PayPal, Crown Electrokinetics, Rocket Laboratories, which is Rocket Lab. They haven't been doing too hot lately, but if you guys didn't get in at the point that I did, then right now would be a better time to get in. As you can see, I'm in the red, but you guys would get a better entry point. I do believe that stock, one of the space stocks, can actually do pretty well going into the next couple of years, but I think right now it's just not getting the attention that it should. However, we've also got Etsy. For those of you that know what Etsy is, it is kind of like an online marketplace where you can buy different things. It's pretty nice, and I would consider it a good stock to hold for retail exposure. Then we've got Lucid. This is another one of those plays that I have where I'm just looking to, see where it goes. I've seen a lot of Lucids on the road as I've, been through a lot of the higher cost of living areas. So it's kind of promising. You don't see as many, obviously, as Tesla, but a lot of people are buying Lucids, which is kind of promising in the sense that potentially the company can recover from what it's doing right now. Then we've got, AMC and GME, the two stocks that are primed for a short squeeze also, which I'm covering in the private community below. in the description. And I'm also going to cover on the channel going to the next few days as we see the price action on those two. We've got StoneCo, SoFi Technologies, which is another company that just does like online banking and credit cards and stuff like that. We've got Tesla, the big EV car manufacturer. And we've got Fisker, which I've lost a lot of money on that. It's also another play that I was high conviction on that did not do too well, but I'm still holding because I believe there's potential for them to possibly in the future make some kind of comeback. They haven't gone completely bankrupt yet, and they haven't been delisted, so there is a little bit of promise there. And also with another EV play, there's Rivian, which I've also seen on the road quite a lot. So those are all of the non-dividend holdings. Now I'm going to get into two of my favorite companies on this list. The first one is Toast. Now you're probably wondering, why did I invest in Toast? So I traveled a lot through the country, outside of the country, in Canada, in Europe, and one thing that I really noticed, you're probably wondering, is what did you notice, right? I noticed that their devices were in most of the restaurants and bars, randomly in San Francisco, New York, Montreal, Europe, Italy, all these places. And it was very interesting to me because I was used to seeing Clover devices and I was used to seeing Square devices, which is Block Inc. essentially now after they renamed themselves. But this was very interesting to me. So I was like, what is this Toast device? At first, when I saw the device come out in the restaurant and they would bring it to me, and most of the places I went to, I was like, wow, it's like almost within the snap of my fingers, all of these restaurants are using Toast. And like, it was like this. And I like to go out and eat a lot, right? So I noticed these things. And immediately, I went to these restaurants and bars and I'm seeing Toast everywhere. And I'm seeing, the big screen devices I've put down below, but when they come to you at the table, they also bring this little handheld device, and then you tap your card on it and put the tip. And I was like, wait a second, let me look into this company. And when I had looked into it, they were around, I believe, $15, $16. So it was quite interesting to me to look at. I was like, okay, well, this looks like it could be promising. That's when I looked at the earnings and I was like, wow, they might be missing EPS a bit, but every single quarter they have increased their revenue. And that was where I invested. And I got in around $18. Now it's at $25. And I believe it's still going to continue growing. I mean, if you're seeing this in all the different restaurants, then like there has to be a reason that they're switching. There's something that they're doing right. Now, I'm not going to speak out of my ass and say I know what it is they're doing right, but I've just noticed a simple trend, which is that they're in a lot more restaurants than prior, when I used to see Block devices everywhere and Clover devices essentially. And also, like I said, they beat their quarter one earnings expectation by 30% in growth from revenue of quarter to quarter. So that's another thing that's really important to look at. Now, the second company I also like a little bit more than Toast. I think Toast is still kind of, past the adoption stage and the infancy stages, and now it's being used by a lot of restaurants. But Hims is a more, higher conviction play for me. And the reason is I've been noticing their ads on TikTok and on Instagram Reels and all these kind of places, on Google, and it's interesting to me because I think they're targeting a demographic, right? So they're targeting people who are in between the ages of perhaps like 22 to 30 that are starting to experience like ED or like hair loss and things like this. I obviously don't have these issues, but a lot of men who reach their 30s start to. And I think it's very interesting the way in which they market this. If you just look at the ads and you do a little bit of research and you look at their homepage, the way that they create this whole user experience is very revolutionary compared to, traditional going to the pharmacy and getting Viagra, whatever. It's just very interesting. So when I had seen these ads, I immediately, looked into the company. It was around $9, and I had bought prior to two of their earnings, and now it's at $16, and I believe it's going to continue growing. Now, this is almost 100% return in less than a year, which I think is amazing, but I think this is just the scratch of the surface. It's just starting to go up. And they beat their quarter one's earnings expectation, and they had 40% growth in revenue from quarter to quarter. Now, for the competition you want to look into, like I said, there's Viagra, Teladoc, Insmed, and a couple of other companies, but none of them have done the marketing that the way Hims has done. And I think it's very interesting. They have Hims and Hers, right? And they have different things for men and women, and they do a very good job of marketing it. And if you just look at their website, it stands out compared to anything else. So that's why I think that their marketing initiatives are better than all the other brands in the space, and why I'm an investor in their company. So now I'm going to go over the total income from portfolio. As you can see, numbers on screen, we're about 71K, about 5,900 a month from essentially, I'd say like four something. I basically had done the math earlier. That's an effective portfolio yield of 24% from everything that I've put together. Now, people might ask, why don't I just put all my money into NVDY or like TSLY and get like 60%? the answer I would give you, and the reason that I think that's a terrible idea, is because you have no diversification and no exposure to other things. It's very important when you're building a very strong dividend portfolio to have exposure to a ton of different markets, and also to have exposure to equities, because you need that to kind of displace the drawdown from some of these. So that's why I have essentially some money in equities, and the rest I have in these income portfolio that I've shown. And it's very important that you do kind of like a 50-50 or a 60-40, where you reinvest 50% of the dividends after tax, and then use the other 50% to do whatever you need to do. Or 60% you reinvest, and 40% to do whatever you need to do after tax, because that's how you can really maximize your return and still have an effective, let's say 12% yield from your portfolio, while still maintaining, higher than S&P 500 appreciation. But yeah, that is all for today. Thank you again. Like and subscribe for more videos, and I will see you guys in the next one.